I want to.
That's terrible. Hey, I want to talk to you guys today about recession proofing your investments in the real estate, commercial real estate realm. So, Dude Real Estate is joining us. That's Nate Shields. He is another blogger on BiggerPockets, and I want to make sure you can hear me. So, before I go any further, can you hear me? I guess you can hear me since I just blasted myself through my speakers. But you may wonder, why is Paul wearing a BiggerPockets hat today? I've never seen Paul in a baseball cap. My wife said I don't look good in a baseball cap, but I'm wearing this baseball cap to celebrate today's news that we are going to be, BiggerPockets is going to be doing their second annual conference, BPCon 2020, and that is going to happen October 5th and 6th in New Orleans, Louisiana, the Big Easy. So it looks like you guys can hear me, so that's awesome. Hey, tell me where you're from and what you do. Hey, Jason Dobbins. Hey, Michael Lenham, Adam Sullivan, David Panic, Off Market Props, Andrew Reyes. Hey, Andrew, welcome. Alfonso Wright. Okay, great. That's awesome. So I'm wearing this hat because we're celebrating the BiggerPockets Conference 2020. It's coming up October 5th and 6th in the Big Easy in New Orleans, and details are forthcoming. Now, you guys probably heard that we sold out last year. We had over 1,000 people, I think it was. Isn't that right, Zach? At the BiggerPockets Conference last year in Nashville. This year we're moving to New Orleans. It's going to be bigger. It's going to be better. And I'm going to be rolling out my new book on self-storage before that, and I'm going to be talking about it at the conference. So before we get started on recession-resistant real estate investing, I thought you guys might want to know some reasons not to invest in real estate. Okay, my wife says I look terrible in the hat. Okay, sorry, honey. All right, thanks. All right, so your life savings is also your emergency fund. These are 10 reasons not to invest in commercial or any kind of real estate. Number one reason, your life savings is also your emergency fund. You need immediate access to every cent of it at every given moment. Number two reason not to invest in real estate, you prefer buying gold because you plan to be a pirate someday. Arrgh. Number three reason not to invest in real estate, you'd rather spend money on a fancy car that will be worth more in 10 years than it is today. Wait a minute. Number four, real estate investing has too much jargon, and you'd rather die than have to learn any new terminology. Number five, what's leverage again? Number six, you're too busy mining cryptocurrency. Number seven, you want your paycheck to be the only income you generate. Number eight, reason not to invest in real estate, you like seeing the red and green arrows on those stock tickers. Number nine, you don't believe in diversification. And number 10 reason not to invest in real estate, you don't want anything to do with cash flow. Okay, hopefully that helps. Hey, that was a little fun there. And we do that a lot of different weeks because we're mocking ourselves. No, we're mocking those who don't like real estate. Isn't that terrible? I don't even believe that. But hopefully we're having some fun with it here. Now, so if you have questions, please hold on to them till a little bit later. If you do have questions on the YouTube side, you can submit them. And my good friend Nate Shields, Dude Real Estate, will try to answer your questions. But after about 15 minutes of talking about recession-resistant investing here, hopefully we'll get into some Q&A for about the next half an hour or so. Man, you guys are from all over the place. So talk about geographic diversity. Hey, Michael Wilcox from Maryland, Robert from Aurora, Colorado. I've been there, love it. Chris Miguel from California. Got somebody from Rochester, New York. I can't pronounce your name, Suk Savana. Thank you so much for joining, you guys and gals, people from all over the country and some people from around the world here. So this is amazing. So a lot of people are worried about the upcoming recession. Maybe you are too. I know that I'm concerned about it. Do you know we're currently in the longest expansion in U.S. history? That means the longest number of consecutive quarters where the economy is growing. And so the 10-year mark was last July. So we are 8 months past that. So we're 8 months. We have a new record by 8 months of the number of expanding quarters. So we are going to have a recession. Now, I highly recommend a book by Howard Marks. It's called Mastering the Market Cycle, Getting the Odds in Your Favor. So check out Howard Marks' book. Howard is a brilliant guy. Warren Buffett reads all of Howard Marks' stuff, and I think probably we should too. He's got a book called The Most Important Thing, where he talks about the 14 most important things. I think it's 14. And then he's got a newer book called Mastering the Market Cycle, and it talks about the importance of understanding where you're at in the cycle. Now, Howard Marks, Ray Dalio, Warren Buffett, Charlie Munger, they say that they do not try to predict when the cycle's going to turn. They don't try to predict when we're going to turn into a recession. They've been around long enough to realize it's very hard to predict because it's based partially on human emotions. And when anything's based on human emotions, it can't really be tracked real well. All we do know is that we need to act appropriately for where we are in the cycle. So that's one lesson about recession-resistant investing. Don't try to predict the timing and the depth and the length of a recession. You know, the last recession was technically, the heart of the recession was only 15 weeks long, and that was the fall of 2008. Now, the aftermath obviously went on for years and years and years. So when my company, Wellings Capital, was trying to figure out how to set up a recession-resistant fund, we were looking for the most recession-resistant assets we could. Now, my book on multifamily investing, it's called The Perfect Investment, and in there I argue that multifamily is somewhat recession-resistant because when people are moving out of homes and downsizing in a recession, they're often moving to places like apartments, and so that makes multifamily partially recession-resistant. Did you know that in the last recession, a lot of residential lenders experienced foreclosure rates up to 10%? Okay, some even 11%. That was local and regional banks. Freddie Mac had foreclosure rates up to, I believe it was 4.8%. Multifamily, at its worst, was only 10% of that. They were about, I believe it was 0.5% foreclosure rate. Think about that. That's 0.5%. So that's 1 out of every 200 multifamily foreclosing in the height of the Great Recession. And now the rates have dropped back to where multifamily is only, I believe it is 2% of the foreclosure rate of residential single-family homes. So the foreclosure rate on multifamily is very, very low. Now, self-storage and mobile home parks are very low as well. So when we were looking for recession-resistant assets, we looked at multifamily, we looked at self-storage, we looked at mobile home parks, we looked at senior living, and we looked at healthcare facilities. So medical facilities, doctors' clinics, offices, etc. And we found out that multifamily and medical clinics were very consolidated, which means they had a lot of professional owners. The owners were typically corporations, companies, smart operators that knew how to maximize the value and knew how to maximize income and knew how to do all the value adds. And so but we found that self-storage and mobile home parks were very different. They had a lot of mom and pop owners, and we found that this was one of the keys to recession-resistant investing, and that is find an asset type where a lot of the owner operators are not professionals. Find an asset type that can be run pretty well without a whole lot of work. Okay, find an asset type that can actually be profitable from someone's living room. Something that somebody thinks, oh, I could run that easily. A mobile home park, a self-storage facility. Now, don't get me wrong. I'm not saying that they can be run really, really well and really professionally from someone's living room without a lot of knowledge, but I'm saying that they can be run and make a profit. It used to be said in self-storage and mobile home park investing, if we build it, they will come. They didn't need to do websites, they didn't need to do advertising, they didn't need to do social media, they didn't need to apply professional standards, put on a lot of value adds, and as a result, there are a lot of assets in these asset types that are mom and pop run, and they're not actually run by professionals. Now let's do a few statistics here. Self-storage. I just wrote a book on self-storage. It's coming out from BiggerPockets soon. And self-storage has almost 54,000 facilities in the US. By the way, 90% of the self-storage in the world is in the United States. But 54,000 facilities. That's about the same as all the Starbucks, Subways, and McDonald's combined. Well, about 76% of them are run by independent or small operators, and a whole lot of them are mom and pops, and you can add a lot of value to them. So let's go through some examples in self-storage. If you can acquire a self-storage facility from a mom and pop operator, you can add a showroom. You can sell locks, boxes, tape, and scissors. Those are retail items. You can also sell insurance. You can charge admin and late fees. You can hold people accountable for paying on time. Wow, that's interesting. You can actually add U-Haul. And often you can actually add additional climate control buildings. So here's an example of what could happen if you bought a mom and pop owned self-storage facility. You go in, and let's say it's making a profit. Maybe it was paid off in 1989, and the operator has maybe moved to Myrtle Beach or Miami, Florida, and they're operating remotely, or maybe they're living on the premises, but they get to know the tenants. They tell them they can pay a little late. They tell them they won't raise their rent. I know one self-storage facility near Chicago where my friend was acquiring it, and all the tenants have been told whatever their original rate was day one, they could keep it forever. Well, that sounds like an operator who's already got his loan paid off, and he's not really interested in a lot of hassle, not interested in a lot of move-ins, and so he wants to keep tenants for life. And that's a strategy, but it's not one to maximize income and value. So you go in as a professional operator, you acquire from a mom and pop operator. You might have delinquency of 10 or 20 or 30%. It means people are paying late or not paying at all. You might have a lot of units that have stuff in them where people haven't paid, and you might have put a padlock on the door, an overlock as they call it, but you might not have gotten around to auction off their stuff. Hey, you're a nice guy, right? You've got some extra space out front, but you haven't done U-Haul or Penske, and you don't have to do that. You don't have to rent trucks, but if you do, there's a huge value add upside, which I'll tell you about in a minute. And let's say the self-storage facility is on 3 acres, but it's got 3 more acres that's being unused. The sign's old and faded. There's no website. So a professional operator goes in and they add, let's say they add U-Haul. Okay, that's just a stroke of a pen, okay? That's not a lot of capital expense. You just add, you put on a contract with U-Haul or Penske, and you can make an additional $2,000 to $5,000 a month in revenue. Now keep that in your mind. Imagine about $3,000 a month, okay? Then you start selling locks, boxes, tape, and scissors, and you add an additional $2,000 a month, okay? Now your occupancy goes up because when you do U-Haul and when you sell retail items, you get a little more traffic there, and often operators say that their traffic increases their occupancy by 3 to 5%. So let's say that adds another $1,000 a month to your revenue. Now, you also have a field over there, and you realize there's a lake nearby, and there's people who want to sell, store RVs and boats. And so what you do is you gravel a little area, maybe a quarter acre, and you see if you can try self-storage for boats, RVs, etc. And if that works, maybe pave a little bit more. And you also do an analysis using a tool called Radius Plus, and you find out that there's hardly any climate-controlled self-storage in the area, so you go out and get some investors and you build an additional building with, let's say, 200 or 300 climate-controlled units. The net effect of all this, of course, you spent a lot of time and money to do all that. The net effect of all this is that your income goes up, and therefore the value of the facility goes up proportionally. Now, you all know in commercial real estate, if you've been watching this show for long, that the value of commercial real estate is the net operating income divided by the cap rate. So unlike in residential real estate, where the value is based on comparable properties or comps, the value in commercial is a formula, it's math. It's the net operating income divided by the cap rate. So if you can increase the net operating income and decrease the cap rate, or even keep it the same, you can significantly increase the value of the asset, okay? And if you use leverage, it leverages your equity increase even more. So let's do a quick example. Let's say you bought a self-storage facility for $2 million. You put $1.2 million in debt on it, and you put $800,000 in cash in it. Now keep that number in mind, $800,000 in cash. Now you added U-Haul, and the U-Haul added $3,000 a month. Okay, that's just one change out of the many we just talked about. Okay, remember, we're talking about recession-resistant investing, buying from a mom and pop owner, and upgrading to professional standards. Okay, so you added $3,000 a month in income. That's $36,000 a year. Now, remember our formula, value is net operating income divided by cap rate. $36,000 a year divided by, let's say, a 6% cap rate, that's 0.06. You just added $600,000. I did that from memory, I hope it's right. $600,000 to the value of your asset. So your asset was $2 million when you acquired it, now it's up to $2.6 million. But the banker doesn't share in that profit. Remember, the debt was $1.2 million. And the equity was $800,000. Well, your $800,000 equity, on paper at least, just went to $1.4 million. You just increased the value of your equity by 75%. Just through a policy change by adding U-Haul or Penske. Folks, this is a big deal. This is a big opportunity. And that doesn't include the locks, boxes, tape, scissors, late fees, getting rid of the delinquent tenants, raising your income, raising your rates by 10%. You know, if you can raise your rates by 10% and keep your costs steady, you could add another 40 or 50% to the value of your equity in that example. And we could go through it if you want to, but trust me, it is a great way to recession-proof your assets. Here's what I mean by that. In a recession, what do people do? They downsize from a huge house to a small house, or they downsize from a small house to an apartment, or they downsize to a mobile home park. And so what happens is they want a place to store their stuff. Now, you guys might have seen the pictures, and you can Google this, from the Depression, where people left beds and nightstands and dressers and desks and all kinds of things along the side of the road as they were traveling during the Dust Bowl and other times during the recession. Well, guess what? That doesn't happen. Somebody said they lost their feed. That doesn't actually happen anymore. You don't see pictures of people. Now, they might take some of that stuff to U-Haul, but generally when people downsize these days, they put their stuff in self-storage. Okay? So it's recession resistant. I didn't say it was recession proof, but then when you add the mom and pop and then the upgrades we talked about, that adds an additional margin of safety. If you can double or triple the value of the equity in 2 or 3 years, And my friends, I can tell you, we see this all the time in the assets we invest in. You can double or triple the value of the equity, then you've created a significant margin of safety, a significant buffer. And so I'm not taking questions right now, but Kenneth Breeze, thank you so much. You asked, how do you source these mom and pop self-storage projects? The best way I know to source them is to do a ton of phone work. You can drive around, you can walk in, you can talk to the owners. A lot of times the owners are working right there, or a key employee. Tell them you're interested in buying it. You can also get lists. You can write handwritten letters. My son does handwritten letters to property owners. He gets a huge response. You can get a team of people, which may include yourself, calling. You can get a list of the phone numbers of hundreds or even thousands of these storage facilities. You target a certain type. There's all kinds of things that can be done. The operator that I invest with every month, he actually has a team of 4 people working the phones, calling mom and pop self-storage and mobile home parks. Let's talk about mobile home parks. Mobile home parks are the only asset class that have a shrinking supply and an increasing demand every year. They're the only asset class that I know of that had absolutely no downturn at all during the last recession. You can look at the graphs and charts. Even self-storage and multifamily had little blips downward, but mobile home parks didn't. They actually did really well, and you can imagine why. They're the lowest rung on the housing ladder. There's houses, then you go down to rental houses, then you go to apartments, and then you go down to mobile home parks. Where do you go down from mobile home parks at $300 or $400 a month pad rent? Well, you go down to under a bridge. And I'm not making fun of people. I'm just saying that's the next rung down on the housing ladder. And so people often don't move out. Tenants are sticky. If they're paying $300, $400, $500 a month in lot rent, where are they going to go to match that? I just went to a mobile home park in Chicago that we might invest in. The lot rent was $700, but the apartments in that area were $1,500. And you can get a lot more space in a mobile home than a typical apartment. And you get a little yard, you have a little community, all kinds of benefits to mobile home park investing for a fraction of apartment or a mortgage in many, many cases. So mobile home park tenants typically won't spend $5,000 to get a mobile home moved when they're only paying $300 a month in lot rent. And so they typically are not going to spend $5,000 just because you raise their rent up to market level. Let's say you go from $300 a month to $330 a month. Okay, let's say you raise their rent by 10%. Okay, but that's going to have a significant impact on the value of your facility. So I think that that is something that you should take into account as you consider recession-resistant investors. All kinds of information. I'm getting a lot of questions here on self-storage and mobile home parks. I'll tell you that I have a free ebooks on each one of those. If you want to get a hold of me at my BiggerPockets, if you want to get hold of me at my BiggerPockets profile, I will get you a copy of my ebook on self-storage investing and my ebook on mobile home park investing. But the key here is what I'm trying to get at is buying from a mom and pop operator, okay? Now we talked about self-storage investing. Let's take an example in mobile home park investing. Now if I have a mobile home park that has 100 spaces and I go in there and I say, okay, there are 30 empty spaces. Now if you can work out a deal with Warren Buffett's company, 21st Mortgage, you can actually, it's not 21st Century as some people think, it's 21st Mortgage, you can actually, someone says they have a 1031 to deploy. Benjamin, I got an idea for you on that. Just get a hold of me. If you can actually get the financing to put a new mobile home on that spot. So let's say you have these 20 or 30 vacant spots. Well, you can actually bring in mobile homes, either used and refurbished, or brand new on those spots. And you can finance those through 21st Mortgage, a Berkshire Hathaway company, okay? So a mom and pop operator is typically not going to do that. Now, a professional operator might also do something kind of crazy. They might pay a move-in bonus. They might say, hey, we're going to finance your first year of rent. Now, you may say, what? That's crazy. Why would I ever do that? You wouldn't if you were working in residential. But in commercial, let's say that rent is $400 a month. That's $4,800 a year. You pay $4,800 out of pocket to get a tenant that's going to stay there for 5, 10, 20 years. It is well worth it. The math off the charts is well worth it. And so that is one way to increase the value of your mobile home park. Second, I already mentioned it, raising the rent up to market level. We don't want to gouge people. We just want to raise it up to a fair market level. Another way to do this is to pass back the water and sewer costs to the tenants. Now that's typical, but a lot of mom and pops haven't done that. They haven't sub-metered or passed back the water and sewer costs. We just invested in a mobile home park yesterday in Louisville, Kentucky. It has 311 spots. And I believe the water and sewer is $200,000 expense to the owner of that mobile home park. By the way, the owner was a mom and pop owner. She lived out of state and she hadn't visited the park in 5 years. What else do I need to say? Actually, it was pretty well run considering that, but how much better could it be run by a professional operator? Anyway, $200,000 or more per year in water and sewer costs. You pass that back to the tenants. Okay, let's do the math on that. $200,000, that's increased income to the park owner, okay? $200,000 divided by a 6% cap rate. I can't use my calculator right now, folks, because I am using my phone to video this. So who can divide $200,000 net operating income divided by 0.06, 6% cap rate? And whenever somebody gets that, I will tell you. Kurt Haynes says, where do I get the book on self-storage? Kurt, it's coming out from BiggerPockets Publishing approximately May or June. You should look for that, pre-sales on that soon. Kenneth Breeze, how do you best source these mom and pop storage projects? I already answered that, maybe kind of poorly, but tried to answer that. John Hollingsworth says, I'm downsizing houses. It closes in a week and a half. I'll have almost zero debt. Great job. Very good income, crazy savings rate, and a large amount of capital to work with. Bring on the recession. Okay, John, gotcha. Okay, so Nate Shields, Dude Real Estate, says 3.33333 million. Okay, so 3.3 million. Now let me do the math on this. This was a $7.1 million purchase. This is the one we bought, acquired yesterday. $7.1 million purchase. Let's just say for fun here that it was $4 million in debt and $3.1 million in equity. You just increase the value of the equity. Now it's going to take a year for this to pan out, but you just increase the equity from 3.1 million by 3.3 million more. You just increased the value of the investor's capital by over 100%. Now it took some effort to pass the water and sewer and sub-meter back to the tenants. Let's say that takes a year, and let's say that costs 300 times 300. That's I think that would be like $100,000 in the water and sewer meters. Okay, so you spend $100,000, you increase the value by 3.3 million. You 110% at least increase the value of your equity. That's powerful, my friends, and that is very possible. Now here's one more example. We recently invested in a mobile home park that had a lot of, I've told this story several times here. It had a lot of cars out front, so it might have had 2 or 3 or 4 cars in front of some of the mobile homes. It might have had a boat. It might have had an RV. It might have had a work trailer. And the operator came in and said after closing, hey, there's a lot of extra stuff outside of these mobile homes. We want to have a nicer, cleaner community, number one. Number two, we want to charge a little more rent, bring it up to market rate. Number three, we want to clean this place up. So they paved an acre out front in front of the mobile home park. And they put a beautiful fence around it, a nice locked gate with a code. And they said, hey, if you've got a third or fourth or fifth or sixth car or a boat or an RV or a work trailer, you've got to park it in here, and we're going to charge you a modest fee to do that. Now, when that 1 acre is all filled up, the operator that we invested with should be making $10,000 a month from that. Okay, $10,000 a month. That is how much per year? That's $120,000 a year. It only cost them $100,000 to do it, so they're making 120% ROI every year. Okay, but forget about that for a minute. $120,000 a year added net operating income divided by 6%, 0.06. That's an increase of $2 million to the value of the equity. Now that mobile home park, let's just say it was a $5 million park, $3 million in debt, $2 million in equity. They just doubled the value of their equity just by setting up this paved parking area and filling it up. It takes some work, but mom and pops typically don't do that. Professional operators often do. Now here's one last way that I love this strategy for recession-resistant assets, okay? REITs, pension funds, life insurance companies want to buy self-storage and mobile home parks. Not all of them, but some of them do. And they want to write very large checks. They don't want to write a $1 million or $2 or $3 million check. They'd rather write a $30 million check. So if you can amass a bunch of well-run, they also don't want hassle. They don't want value adds. They don't want drama. They want something professionally run, professionally named, managed, marketed, etc. If you can take these assets from the bottom level, that would be, a mom and pop level, up to a professionally run asset, and then you can amass a portfolio of these so you can get a large check, you can compress the cap rate in our equation. So if you can take a cap rate of 7% when you acquire all these assets and take it down to 5.5%, you can do the math yourself. That's an increase of about another 20 or 25% or more in the value of the asset. But a 25% increase in the value of the asset with appropriate debt on it could be a 60% or so increase in the value of the equity. Yeah, I just said that. Another 60% appreciation to your equity just by finding the right buyer on the back end. So you get the right seller, mom and pop, the right buyer, a REIT or a professional operator, and you do the hard work in the middle to bring it up from the bottom to the top, and you've got an incredible formula for recession-resistant investing, okay? So hopefully that helped. If you have any other questions, you can contact me. I'm Paul Moore from Wellings Capital, and thanks Ryan Haley, 3.3 million. Thanks for joining us on the BiggerPockets network. If you want to talk more about this, I am going to do a call at noon on Wednesday where I can answer more detailed questions. There's a lot of questions here that Dude Real Estate, Nate Shields, can't get to on YouTube, and a lot of you, my friends here, can't get answers to. So I'm going to answer as many questions as I can in the next 15 or 20 minutes, and then we're going to call it a day and enjoy our weekend. So Kenneth Breeze says, how do you source the private equity part of your investment syndications on your deals? Ken's from Germany. Hey, so if anybody is interested in investing with Kenneth Breeze in Germany, you can check out his profile. Kenneth, there are 7 paths to get involved in commercial real estate, and I know this isn't super helpful, but the book I'm writing on self-storage outlines that in great detail. It explains all 7 paths. You can also go back and find some of the other articles I've written on BiggerPockets and some other of these presentations, including the one I did exactly 1 week ago where in the last 10 minutes of the show, I go over those 7 paths. And that explains what you do as far as finding equity for deals. It's not easy, but it is possible. Yes, Kenneth, you can replay this webinar. Hey folks, if you like this show, or if you like these types of shows, please give us a thumbs up, a like, or a share. I want to make sure BiggerPockets doesn't fire me before the conference. Hoping to speak there in New Orleans. I'm actually going to be speaking, but anyway. So Tennis Buff says, I'm considering self-storage. Thanks so much. Hey, that's great. Folks, if you want to get more training on self-storage, a friend of mine, Scott Myers, that's Meyers, has some amazing training that will help you learn to invest in self-storage. Scott Myers is active on BiggerPockets. You can find him. Vincent says, I can't find an investor to go with me. Would you recommend trying to get a loan from a bank? So I think you're talking to Dude Real Estate. So I'm going to let you all go over that together. Tennis Buff said something about mobile home parks. Very, very hard to do a ground up mobile home park. In fact, I think Tennis Buff and others, I think it's almost impossible to do a ground up mobile home park. I believe there are only 5 or 10 built in the US annually. That should tell you something. And even if you could get all the permits to build them, it probably would be so far out of town that you'd be in a bad location and you would have a very, very hard time getting to break even. I don't honestly think there's any sensible way to do a ground up mobile home park. You might be able to do an RV park, and that's not what we're talking about today. But I've got a friend, Ryan Haley, out in Woodland Park, Colorado, where there's a lot of RV parks. Maybe he can speak to that. I don't know. Hey, Aaron Reamer, what about owning several mobile homes and renting them independently? Less risk, small margins, not owning the park. Aaron, I can only speak from my own experience. I've owned 4 mobile homes as part of my many flips and single family rentals I've done over the years. They've been 4 of the worst investments I've ever made. And I can honestly tell you that Frank and Dave, who do a lot of mobile home park training, Ryan Smith with Elevation Fund, other people who have been in the mobile home park world hate that model. And I don't want to offend our friends who do that type of thing. There's probably people on here who do it. I think it's a very, very difficult model to make work, and I think a lot of people get out of it, honestly. YRN Fennell, thank you. Do you think self-storage is oversaturated? Absolutely. That's why you've got to use a tool called Radius Plus to make sure you're not buying or building in an oversaturated market. I can tell you that it's hyper-local. So while I can say Nashville is generally overheated, I can tell you that if you go to the southwest part of Nashville, like Belmont or Bellevue, you can actually find places where there's hardly any self-storage at all. So hopefully that is helpful. But there are certainly a lot of self-storage facilities being built. I think we can all agree on that. Frank Gasoras J says, do you think the multifamily market is oversaturated? Do I think the coronavirus will kickstart the next recession? You know, I've got a friend who's been making money, crushing it in trading options for about 3 years right now. And the coronavirus just cost him like 60% of his portfolio. He made a really bad trade chasing this one deal, and he kept throwing bad money after good money after bad. You know what I'm talking about. Multifamily. I wrote a book called The Perfect Investment about multifamily. I love multifamily, and I think it's overheated. The perfect investment is no longer perfect if you can't get deals that make financial sense. And so you can get that book. I still believe everything in the book, but honestly, I wouldn't invest in multifamily right now unless it was an exceptional deal from a mom and pop seller. Did you know 93% of multifamily over 50 units are owned by corporations and professionals who've already run the value out? but only about 24% of self-storage are owned by big companies. And mobile home parks, it's believed that about 90% are owned by mom and pops. So mobile home parks are especially well suited for this recession-resistant investing that I'm talking about today. Okay, so we're getting toward the end of our show. And so if you had a question from earlier that you didn't get answered, please copy and paste it into your browser and hit send again. I would love to be able to answer your questions. So would Nate Shields, do real estate, and we will try to get all your questions answered before we wrap up. Okay, Joe Split Rock. Hey, Joe, what would I invest in? I do invest in self-storage and mobile home parks, and I love those asset classes. Okay, so Ryan Haley says RV parks are something we looked at recently, and occupancy demand here in Colorado and elsewhere is through the roof. Consistently 100% occupied and sold out, so it's hard to find spots. Okay, so if anybody here is knowledgeable about RV parks, RV park investing, feel free to weigh in. Maybe Ryan Haley, maybe you'd like to do that. Ryan Haley, by the way. Ryan, what's your book you've got coming out? You've got an amazing book coming out soon. You guys ought to look for it. Ryan Haley's a real estate investor, really smart guy. He's also in Colorado, so he's got to be a good guy. And anyway, Ryan and I are going to do some marketing together soon, I hope. Frankosaurus J says, do you think I could get into a deal for $40,000? Absolutely. I know a guy right now who is looking, who would love to have $40,000 to help invest in his 27-unit apartment deal in Lynchburg, Virginia. And so he's looking for like a couple $100,000. So there's lots of people out there, but you got to be really careful. Like I said, multifamily is largely overheated. There are deals out there. There are syndicators out there who will go $25,000 and up. And so, yeah, for $40,000, you could almost get into two deals. Through crowdfunding websites, you might be able to get into two deals, Frankosaurus J. And it looks like Nate Shields is weighing in on your question as well. Just be careful. Don't throw money at the first deal you see, unless it's a good one. Check them out. We have a like 20. Okay, so I have 25, 26, 27 point criteria page here before I'll invest in any operator or any deal. And no, I'm not going to go over that, sorry. But we spend a lot of time vetting operators, an enormous amount of time. Warren Buffett spent hundreds of millions of dollars way back in 1979 when he wasn't that rich. Well, yeah, he was. But anyway, he spent hundreds of millions of dollars investing with capital cities to acquire ABC, which they sold 17 years later to Disney for billions of dollars of profit. He did that based on a 15-minute phone call. Why? Because he trusted Tom Murphy. Because he trusted the guy on the other end of the phone line who told him in 15 minutes why they needed to do this. So you all need to really get to know the operator. If you're going to give money to somebody, you need to get to know them. You need to be really, really sure. You need to see how they treat the waiter. See how they talk about their spouse. See how they talk about their investors, their employees. See what they say when no one's looking, if you can. And drop in on them, check them out, check out their background, check out their criminal record, if any. You need to, it's better to do a great deal at a fair price than a mediocre deal at a great price. Okay, that's a Warren Buffett or Charlie Munger quote. And I highly recommend that you consider the operator as being part of that equation to find a great deal. A great operator can a great operator can fix a bad deal. A terrible operator can mess up the perfect deal. Okay? So Maria says, is it possible for a newbie investor to get involved in mobile home park investing? Yeah, I think it is. Maria, especially if you have money or if you have the opportunity, if you have money or time, you can get the knowledge to do it. So I think you can. There's probably several paths. If you watch my last week's show, the last 10 minutes of the show, like I said, you can actually watch where I talk about 7 paths to get in to mobile home parks, self-storage, etc. Kenneth says multifamily is insane. You can't fix a bad purchase later. Yeah, that's right. You make your money when you buy and when you operate. I agree, Kenneth. Joe Split Rock. Okay, I already answered that. Matt Fox, do you like vacation rentals in a strong vacation area? Yeah, but they're really hard to get a good deal on right now. Matt, if you can hold on, if you can hold your cash and get a phenomenal deal in a down market, that's when you want to buy vacation rentals. That's my opinion. Somebody else might have a different experience. Okay, do you have a question? Do you have a comment? Do you have a complaint? Now's the time to make it because we're getting ready to wrap up. So Ryan Haley, your book is called A Better Way. A Better Way, that sounds interesting. I want a better way. So you might want to check that out. And Ryan, when does your book go live? Is it coming out like in a few weeks? Tell us. All right, so Kenneth Breeze, okay. Dude Real Estate says, yes, you can do vacation rentals. Vincent Bat says, would you recommend investing in single family or Airbnb more? Obviously depends on the deal, but overall. You know, folks, I talk about this almost every week on the show. I'm going to spend a minute talking to you newbies or folks that have limited time or limited money to get involved in real estate investing, okay? So I'm going to tell you at least 2 strategies where you can jump into real estate investing today. Is anybody interested in that? Give me a thumbs up, a like, or a heart, or something like that if you're interested in that topic. Okay, let's do it. Okay, so one thing you can do is you can get, Ryan Haley says he has a podcast. I was on the podcast, A Better Way Podcast, abetterwaypodcast.com. Thanks, Ryan. And the book's coming out in a couple weeks. So, all right. So one way to get involved if you're new is to do a corporate Airbnb arbitrage. Now I say corporate, it's really corporate and Airbnb. Here's what you do. You find a way to rent an apartment or rent a house or rent a side of a duplex. You fix it up real nice and you put it on the corporate rental market, okay? Now, you're renting it for, let's say, I'm just making up a number, $800 a month. Then you put all the beautiful stuff in it, take professional photography, get the utilities set up, and then what you do is you go out and look for a corporate tenant, okay? And that would be a tenant who comes in for 3 to 4 to 6 months or more, okay? Now, until you get a corporate tenant, you rent it out short-term on Airbnb, and you keep a really short leash on it, so you don't rent it out 6 months ahead. You just rent it out for the next several weeks at a time, okay? Then when you get a corporate tenant, you sit back and relax. Often a corporate tenant will pay, and again, it's very market specific, so New York, San Francisco might be triple this, but a corporate tenant might pay for a furnished house that they have on flexible terms with all the utilities they can just walk right into on a Sunday night and move into for 4 months. It might be an engineer, a professor, a pilot, all types of things. They will often pay, say, $1,500, $1,800, $2,200 a month for that house, whereas or that apartment, and that apartment might rent for like $800 a month as a base rent. So you get to keep the profit, and you might only have to clean it like once a month, and you might have to go out and market for a new tenant occasionally. Now I know a guy who was doing this, and he actually fixed up an apartment. He was really shy, and he didn't want to go out and do marketing, but he heard that there were these pilots who were staying at a local airport to get training. I guess it was flight school. He finally had the nerve to go talk to the manager of the small airport. And the manager of the small airport followed him back to his apartment. He looked around. He said, okay, I'll take it. Can you get me 52 more of these? What? He had 53 pilots he wanted to house. And he didn't want to put them up at Homewood Suites. or Residence Inn or whatever. If you're near a Homewood Suites or a Residence Inn or whatever, you might be in a great location to bring in corporate tenants. Now Tom says, hey Tom, where do you find corporate tenants? There's 17 places to find them. And one way is just by hanging around the Homewood Suites or Residence Inn lobby or whatever and seeing what companies these people work for. Maybe you can go and have a drink or dinner with them, and then just go back to that company and say, hey, I'm interested in providing corporate housing. Another way is through Craigslist. Another way is just through other online advertising. Another way is just going to big employers. Like, there's a hospital in Lexington, Kentucky that has, I've heard, they have a whole wing that is not staffed with nurses because they don't have enough nurses, and the nurses need housing when they come. So physical therapists, that's another group. Traveling doctors, there's all kinds of people. Surveyors, professors, people in graduate school, international students. There's all kinds of people who need flexible corporate housing. And again, you plug Airbnb in the gaps. Now I have a friend named Al who teaches people to do this. And he teaches people to do corporate Airbnb and this arbitrage strategy. And two people who were on this very show 20 months ago in the summer of 2018 came up to me at the BiggerPockets conference in Nashville, and they said, we're doing what you said, and we're making $70,000 a month. And I said, you're making $7,000 a month? That's really good. And they said, no, we're making $70,000 a month. Now that's gross. They have tons of expenses, like their expenses are probably $35,000, they told me. So they're probably pocketing $35,000 in profit. Pretty cool strategy, something you can get into pretty easily. Now, if you own an apartment or a house or a duplex, you can even do it better. You don't have to rent it, but I think you can actually leverage your time and leverage yourself much better if you rent these apartments. There's all kinds of strategy. Like I said, my friend Al trains people to do this. If you want to get hold of me, I can tell you how to reach Al. I told you I'd tell you two different ways. The other way is, if you're getting started, is a lease option sandwich. There's not a lot of training on this, but I think that lease option sandwich, you probably want to, hey Vincent, like anybody, just get hold of me at my BiggerPockets profile and I'll connect you with Al. Okay, so the lease option sandwich is actually kind of a similar strategy. You rent to own a house, okay, and then you turn around and do some little improvement to it, and then you rent to own it to somebody else. Now this is actually similar to the thing I was talking about 45 minutes ago. You rent to own from a distressed seller. Let's say they're about to go to foreclosure on the courthouse steps. Then you take it up to the market level and you rent to own it out to somebody else. And that difference in monthly rent, okay, what you charge versus what you're spending on the mortgage for the previous seller, that difference is profit to you. And then there's also the difference in sales price. So I did this once. I bought one for about $148,000 and I sold it a few days later, sold it for $190,000. It took the guy 3 years of rent payments where I made a profit every month for three years, and at the end of the 3 years, he closed, and I pocketed I think it was like $40,000 profit when he closed. So I made like a couple $100 a month for 3 years and $40,000 at the end of the line. If you want more information on rent to own or lease option sandwiches, you can go and check out Chris Prefontaine. He is a writer for BiggerPockets, and he also has some training on lease option and rent to own sandwiches. I think his website is like Wicked Smart Real Estate or something like that. Chris Prefontaine was on my podcast, the How to Lose Money podcast, and I think I was on his podcast as well. Folks, it is 4:09, and at 4:10 I'm going to wrap up, 4:10 Eastern. So, do I buy value-add apartments? Not right now, Narissa, but I will, again, when the market turns. Okay, so this has been really fun. I can't believe I get to do this. Zach Gwynn, thank you so much. BiggerPockets, thank you so much. All you hundreds of folks watching, thank you. I really appreciate every one of you. And I'm really excited to see you guys again. We may do it a different time next Friday, so watch your email or your social media, and we will see you live here next week. I'm Paul Moore. I'm with BiggerPockets and Wellings Capital, and I look forward to seeing you again in the near future. Thanks. Have a great day. Have a great weekend.